Welcome to our Liechtenstein Financial Services podcast. In the Liechtenstein Financial Services podcast, we will explore the legal, regulatory and tax perspectives of banks, funds, asset managers and other participants in the Liechtenstein Financial Center, a production of PwC Liechtenstein. Today we are discussing with the Crypto Asset Reporting Framework CARF. I'm Ilario Monti, your host with 11 years of experience at PwC, specializing in auditing, consulting for banks and other financial service institutions. With this podcast, we aim to dive into the newly introduced CARF. These changes are crucial for ensuring transparency and preventing tax evasion in the rapidly growing crypto asset market. We will explore the main features of CARF, how it impacts global tax compliance, and how financial institutions and crypto asset service providers are adapting to these changes. Joining us today is Matthias Stabli, Director at PwC and an esteemed expert in tax and legal services. Welcome, Matthias.
Thank you, Ilario. It's great to be here and talk about this topic with you.
Matthias, can you tell us a bit about yourself and your connection to Liechtenstein?
Sure, happy to do so. Well, I was born and raised in the canton Thurgau, so I know Liechtenstein since I was a child. I even came to Liechtenstein for day visits with my grandparents, and well, there's some nice child memories, and going to another country for a child in that age was just amazing. It's a pleasure for me to be responsible for the operational tax practice in Liechtenstein, covering QI, FATCA, CRS, and now also CARF.
Thank you, Matthias. Let's start with the discussion about CARF. Could you explain what the Crypto Asset Reporting Framework is and why was it introduced?
Certainly. The goal of the OECD is to ensure and increase tax transparency in order to ensure tax compliance. Almost 10 years ago, the OECD introduced the automatic exchange of information. Under those rules, financial institutions have to report their account holders to the tax administration for an international exchange. However, the automatic exchange of information only focuses on traditional financial market products, but not crypto assets. Now, in light of the rapid growth of the crypto market in the last years, the OECD introduced this new tax transparency and tax reporting regime called CARF. With the help of CARF, the OECD now wants to expand the reporting obligation to ensure tax compliance with respect to crypto investments by expanding the scope of entities that have to do a reporting and to include crypto assets into the reporting framework.
It's interesting, Matthias, to see how CARF is helping connect the crypto world with traditional financial systems, ensuring both are aligned in terms of transparency and compliance. How does CARF differ from existing common reporting standard series?
First of all, it covers not the typical financial products, but it covers the crypto assets. So that's one of the main differences. Secondly, we see a big change in the type of reporting. Under CRS, the reporting was done based on year-end values. CARF extends this transparency by introducing a transactional-based reporting framework. Last but not least, the CRS mainly targeted traditional financial institutions like investment entities, banks, and so on. CARF also affects those traditional investment entities or banks if they have a crypto offering. But CARF also specifically addresses crypto asset service providers like exchanges and crypto wallet providers or brokers. It brings them into the newly documentation and reporting obligation.
That's a key difference, Matthias. By focusing on crypto asset services providers, CARF ensures that the entire crypto ecosystem, including decentralized platforms, is included. What types of crypto assets are covered under CARF and which are excluded?
Well, CARF applies generally to crypto assets, and the OECD applied a very broad definition. Generally, it includes every digital representation of a value that relies on a cryptographically secured distributed ledger technology. From this very broad definition, the CARF excludes central bank digital currencies and specified electronic money products, because they will be reported under the amended CRS rules, right? And in addition, there is another category which is excluded. That's the assets which are not for payment or investment purpose. And I have to admit that this is a very interesting category, because we don't have yet definitions and clear guidance what should be included in that.
Interesting, Matthias. What are the key reporting requirements under CARF for crypto asset service providers?
Well, the crypto asset service providers will have to report details about the transactions involving crypto assets, including exchanges between crypto assets and fiat currencies and transfers of crypto assets. The reporting will include every single transaction. So, for example, I exchanged X amount of crypto assets into fiat or into another crypto asset. Also, an airdrop or income from staking would have to be reported under the CARF rules. In addition, they will also have to include the reporting information about the user, the name, the tax residency, and so on, and the type of the transaction in details.
Reporting on such detailed transactions will certainly help tax authorities track crypto asset movements more effectively. Matthias, another question. How are the due diligence procedures structured under CARF to ensure accurate reporting?
Well, CARF outlines the due diligence procedures for identification of the crypto asset user and determining his or her tax residency. Crypto asset service providers must collect a so-called self-certification from the users and verify that compared to the AML or anti-money laundering information and the Know Your Customer procedures. Further, they will have to implement specific procedures to monitor changing circumstances, and we should also keep in mind that the collection of those documents will have to start first in January 2026.
Okay, this sounds like a lot of open items to become CARF compliant. My last question, Matthias. What should entities in Liechtenstein now do?
I think it is crucial to perform now an impact assessment in order to have a full understanding of if and how we are impacted by this as an entity. Because we need to understand what do we need to do. Secondly, the entities affected by CARF should think about how to implement it. What do we want to do by ourselves? Where do we need support? How do we collect the information? How do we prepare the reporting?
Thank you, Matthias, for these insightful explanations. CARF represents a significant step forward in addressing the tax compliance challenges posed by the growing crypto asset market. By extending the common reporting standard to include crypto assets, it ensures that financial transparency is maintained, even in the decentralized world of crypto.
Thank you very much, Ilario. It was a pleasure to discuss this important new development with you.
Thank you, Matthias. From this basis, we will dive into new topics such as legal, regulatory, or other topics in future episodes. So stay tuned for our upcoming episodes. In the meantime, contact us for a personal exchange how Liechtenstein can fit into your agenda.